Welcome back to today's explainer. So in our previous foundation lesson, we outlined the 11 stages of the revenue cycle. Now, that's a fantastic high-level view. But today we need to go one level deeper. We're taking those theoretical stages and mapping them directly to the real world. To make sense of all this, we're going to use a highly structured approach. Today, we're looking at the cycle foundation. Who owns the cycle? Segregation of duties, the essential paper trail, the accounting entries, and then a quick look ahead at controls and risks. Section 1. Cycle foundation, moving beyond the 11 stages.
Okay, you already know what the 11 stages are, right? Well, now it's time to ground them in pure operational reality. A business isn't just some checklist on a whiteboard. It's a living, breathing ecosystem. So we're going to look at exactly who owns the work across the different departments, what specific documents act as evidence, and how all of this activity ultimately hits the general ledger.
Section 2. Pillar 1. Who owns the cycle? Let's start right at the front end. Marketing and sales are your growth engines. Marketing is out there generating and qualifying leads, while sales takes that baton to prep quotes, manage the orders, and, crucially, own the customer relationship. But notice what happens next. Finance steps in. The finance credit team objectively assesses customer creditworthiness, which, let's be honest, often frustrates an eager sales rep ready to close a deal. They set the terms and monitor risk. Then the finance billing team takes over to generate accurate invoices and handle disputes. So you've got your revenue drivers perfectly balanced by your risk managers. As we move down the chain, the process hands off again. Operations or delivery actually fulfills the order and gets the customer to sign off. Meanwhile, back in finance, the AR and collections team is monitoring aging, applying cash, and escalating when necessary. Accounting is focused on recognizing revenue per policy and managing the period close. And sitting right above the fray is management, approving exceptions, monitoring KPIs, and making the really tough calls on things like credit holds and write-offs. Section 3. Segregation of duties, the golden rule. So, seeing all those distinct handoffs leads us to a really important question. Picture this plain language scenario. What if the exact same person negotiates a sale, issues the bill, and then receives the customer's cash? Just think about that for a second. What could possibly go wrong there? Well, the answer is pretty much everything. Sales, billing, cash application, and reconciliation must absolutely never be held by the same person. They are fundamentally incompatible roles. If you allow one person to control the sale, the invoice, and the incoming cash, you are literally creating a massive vulnerability for both innocent errors and intentional fraud. When you're advising clients, spotting a lack of segregation among these roles is absolutely one of the first control gaps you have to call out. Section 4. Pillar 2. The essential paper trail. Now that we know who is doing what, let's look at the connective tissue of the business. Every single stage requires a specific document. At the quote stage, sales owns the proposal to establish price. Then, finance owns the credit application to assess risk before moving forward. Once approved, we get the sales order, which authorizes fulfillment and acts as our primary source of truth. Now let's really zoom in on the delivery note. This piece of paper, owned by operations, is not just administrative bureaucracy, it's the critical legal proof of delivery. From an accounting standpoint, this physical signature is the exact trigger that allows billing and revenue recognition to actually begin. I mean, if operations loses this note in the back of a delivery truck, the entire financial process grinds to a total halt. Following that trigger, finance issues the invoice, creating the accounts receivable. When the customer pays, the remittance serves as hard evidence of the cash receipt. If they don't pay, finance relies on the AR aging report to monitor overdue balances and chase it down. And finally, accounting uses the reconciliation report at period close to confirm that accounts receivable matches the general ledger, which perfectly matches the bank. It's a paper trail that seamlessly connects front office operations to the back office close. Section 5. Pillar 3. Accounting and journal entries. Here is where we translate that carefully constructed paper trail into the universal language of business. Accounting is really just a chronological timeline of business events. And as an advisor, you've got to understand the exact timing and conditions for each entry based on what actually happened out there in operations. Let's start with invoice issuance. You generally have two potential conditions here. First, if the invoice goes out and the revenue criteria is already met, like you just handed over a physical product, boom, you record accounts receivable and recognize the revenue immediately. But what if you issue an invoice for an annual software license on day one, way before the service is provided? The revenue isn't earned yet. In that case, you still record accounts receivable, but the credit goes to a deferred revenue or advanced billing liability account.
Then, as time naturally passes and you actually deliver that service, that deferred revenue is finally earned. You reduce your liability and recognize the real revenue. Later on, at actual cash receipt, you increase cash and reduce your accounts receivable. And lastly, at period end, we have a reality check. Sadly, not everyone pays. So management and accounting look at the AR aging report and recognize an allowance for doubtful accounts, recognizing a bad debt expense so those receivables aren't looking better than they actually are.
Section 6, Next Steps, Controls, Risks, and KPIs. We've successfully mapped out a highly structured corporate system today. The dedicated roles, the essential documents, the precise accounting rules. But I want to leave you with a provocative thought. What actually happens to a business when this perfectly structured system completely breaks down? What happens when that golden rule of segregation of duties fails? Or a bad actor just bypasses the controls entirely? Well, that brings us right to our next logical step. In our upcoming explainer, we are going to dive into exactly what can go wrong within this cycle, and more importantly, how you can step in to prevent and detect it. I'll see you in the next one.